Welcome back. Excited to be with you again. We are carrying on our series on financial planning for dental practice owners, turning financial chaos into financial freedom. I just got done with 2 episodes on the tax side of phase 3, which is doing a business financial plan to support your, what was phase 2, personal financial plan for independence. So going through the sequence, number 1, assemble a great team, have a systematic cadence of meeting with them, find a management system. In my preferred system of team formation, of roster building, is to meet on a regular cadence. We use EOS over here at Practice CFO. In the dental space, there's one called DEO. I'll give them a little shout out, Dental Entrepreneur Organization, which is sort of a spinoff of EOS for dentists. I think they do have a little bit higher fee, where in EOS, you could essentially self-implement that at no cost other than a few books. And then also make sure to meet with this team regularly. Use a system, a software, a format of how you run these meetings and the cadence. That is phase 1 or step 1 is to develop your team. Number 2 is the personal financial plan. Number 3 is the business financial plan. 4, supporting the personal financial plan. And then number 5 is implement, monitor, and revise. And all right, so now we are in that phase 3, a business financial plan. We talked about your financial reporting. We talked about your break-evens. We've talked about your tax plan. Now I'm going to talk about determining your payroll, step 4 within this section. Determine your payroll as an S-Corp practice owner. If you're a sole prop, this doesn't apply. If you are doing more than roughly $800,000 or so in collections, you should probably convert to an S corporation from a sole proprietor. Please don't be a C corporation. If you're a partnership, please own your partnership through a wholly owned S corporation. That's what's called a partnership of corporations. And so you will, as an S corporation owner, you need to pay yourself a W-2 as an employee of your own corporation. How much should you pay yourself? That's the subject of this episode. It's going to be a shorter one. Number one is if you do not have a retirement plan. And when I say retirement plan, there's 2 semantics around retirement plan. One is you met with a financial planner, you forecasted out when you want to be financially independent, you back into what you need to be savings and what you need to be doing to meet that long-term goal. That is a retirement plan. But in the context of your business, a retirement plan is these things called 401ks or SEP IRAs or simple IRAs or cash balance defined benefit plans. There's a few others. These are all under this act called the ERISA Act, the Employee Retirement Income Security Act, which was, I think, from like the 60s or 70s, a long time ago. But it put into place this sort of tax advantaged investment vehicle that businesses can set up, large or small. Even if you're alone with no employees, you can set up a solo 401k, which is actually a beautiful thing. But you can set these up. You're able to get a tax deduction by funding it and by deferring some of your income that you would pay taxes on today into it and getting a tax deduction. So in other words, it's not taxed. That portion of your income is not taxed, which is the same thing as a tax deduction. It's not taxed.
Are you looking to buy or sell a dental practice? If you're a seller, how do you find a strong list of potential buyers? There's no MLS or Zillow for dental practice sales. In such a fragmented market, many dentists selling their practice feel discouraged. That's why I built PracticeOrbit.com. PracticeOrbit is modernizing how dental practices are bought and sold. It's a platform technology. Y'all know them: Zillow, Airbnb, Uber, and OpenTable, just to name a few. These technologies do 2 things. First, they help match buyers and sellers by centralizing the marketplace. Second, once the match between buyer and seller is made, these technologies help them navigate the sale to a successful close. Here are a few of the features inside of PracticeOrbit. Users can determine a reasonable sale price for a practice in just minutes. All they need is the most recent business tax return. Practice owners can use the directory to find important service providers like practice brokers, attorneys, accountants, and bankers. Practice owners and their brokers can invite those service providers into the platform, so all parties are coordinating the sale together. Practice owners will have a beautiful digital listing of their practice, like a home on Redfin. And importantly, the listing will be anonymous, and personal information like your address, name, and pictures are only released after an NDA is signed and approved by you or your broker. Practice buyers can create saved searches to be auto-notified when new listings come on the platform that fit their desired specialty and location. And hey, dental practice brokers, you can list all your practices on the site for free. By doing so, you'll get access to PracticeOrbit's large pool of buyers, all of whom have created profiles and saved searches to be auto-notified when new listings come for sale. You can use the platform to introduce your listings to a targeted set of buyers. Additionally, and optionally, you can use the platform tools such as a built-in NDA, a customizable LOI, and a workflow tool to navigate the sale from LOI to closing. In fact, you can manage all your listings on the system from listing the practice to NDA to LOI and finally to closing the deal. Create your free account today at www.practiceorbit.com.
Or you can do a Roth 401k, which I love Roth 401ks. You do pay the taxes today. It goes into your 401k or Roth IRA on the outside of your business, but on the inside of your business, it's a 401k, not a traditional IRA. I don't like SEP IRAs, never have. You can't fund as much into them, and you have to fund a lot more for your team. I've never been a fan of simple 401ks because you can't fund much into those things. Never have I intentionally set up a simple or SEP IRA. I've set up plenty of solo 401ks for doctors who are independent contractors, maybe roaming specialists who don't have employees. Done a lot of those, but our standard is doing a traditional 401k. When you set that up, you as the employee of your own corporation can do a regular 401k, or you can do a Roth 401k contribution. It is $23,000 if you're under today in 2025. If you're under age 50, you can add on another $7,500 if you're older than age 50 for $30,500 total. That is the employee portion. And then on top of the employee portion, you can fund an employer portion. And there's two buckets there. There's what's called the safe harbor. And the second one is called the profit share. You can fund the safe harbor means that safe harbor always means this in the tax code. If you do A, then you're allowed to do B. In this case, the safe harbor is if you fund a certain amount to the employees as an employer contribution, as a benefit, not them paying out of their own paycheck, but you pay them. If you pay them a certain amount, it allows you to fully fund that portion for yourself, the $23,000 I just mentioned, or if you're older than 50, the $30,500. Okay, the employee portion is called the elective deferral. They're electing to defer some of their income into the 401k. Elected deferral, EDs, elected deferral. And your employees, they determine that amount. That's no skin off your back. But in order for you to fund your own elected deferral as the owner or your spouse on there as well, you got to fund a little bit to your team, and that's called the safe harbor contribution. Safe harbor. If you do this, i.e. fund a little bit to your team, you can do that, i.e. fund your elective deferrals. And you as well as an employee of your own corporation get a little bit of safe harbor. Now, the safe harbor allows you two options. You can do a match where you match dollar for dollar what they put in, or you can do an automatic 3%. So if they don't put in anything, but they're eligible because they've been there long enough, then they get 3% of their pay no matter what. Now, if you're going to do that third bucket called the profit share, so the three buckets are the elected deferral, the safe harbor, the profit share. The safe harbor and the profit share is the employer portion. If you're going to do that third bucket of profit share, then we usually recommend you actually do the 3% automatic option for the safe harbor, because that plays double duty. That dollar that you put in the safe harbor also covers your staff in the profit share portion, which is a bigger portion. You can throw in usually another roughly $25,000 to $30,000 a year into the profit share for yourself, but that's usually going to come at about 20% of that will be added to it to cover your team. And the safe harbor option of 3% allows you to do more at a lower staff cost collectively across the safe harbor and profit share typically. If you don't do that last layer of a safe harbor, then I would recommend the match option for your safe harbor. If you don't do that last option of the profit share, that last option of the profit share, then I probably would just do a match for the safe harbor. Now, that was maybe a bit much. Synthesizing that down, topping it off one more time. In the 401k, you have three buckets that you can fund. You have the elected deferral out of your employee paycheck and your own paycheck. You have the safe harbor, which you have to do if you want to do your bucket one for you personally. And then you have the profit share, which is bucket three, which is this additional sort of bonus amount that you can put in to get more tax deductible contributions. Now, out of all of that, the only one, it's all 100% tax deductible, 100%. Your business deducts 100% of the employer contribution, and from your W-2, you get to deduct 100% of your own elected deferral. Same with your spouse. However, of those three buckets, the only one where you have an after-tax Roth option, where you don't get a tax deduction for it now, but it grows tax-free as opposed to tax-deferred, which means it'll grow tax-free, and when you pull the money out, you don't pay taxes on it, on the contribution or the growth. That's why I love Roth so much. We don't know what our tax situation is going to be like in the future. It sure is nice to know that we have a portion of our savings that is in a bucket that will never, ever, ever be taxed again. Now, I don't think that the IRS will ever go in and try to get their sticky paws on that tax-free money because you already paid taxes on it. Could that happen if the government is desperate? Who knows? We're in a massive debt situation economically in this country, and they may get desperate. However, I don't think that will ever, ever happen because you already bit the bullet of paying taxes on that Roth. So the safe harbor and the profit share, you cannot do a Roth contribution. That will always be tax deductible to the employer, tax deferred to the employee. And so even if you're in the highest tax bracket, if cash flows allow it, I really like to do that Roth IRA for you. And if your spouse is on there and you're older than 50, that is $61,000 that you could get in there that's going to grow tax deferred. So if that turns into $300,000-$400,000 over 15 to 20 years, you're not going to have to pay $1 of taxes when you pull that out. And it's a beautiful thing. I call this tax diversification. I like it when you have a tax-free bucket of investments, a tax deferred bucket of investments. And if those two are sort of capped out, then you can even have a taxable bucket of investments through a normal brokerage account as well. And that's tax diversification. And then what you invest in each of those accounts should be different. Like in your tax-free bucket, I would put the highest risk, highest growth stuff, like emerging markets. Over time, they're very volatile, but they tend to have larger returns over time because of the related risk. And therefore, if that grows the most, that's what I want to be tax-free. And then in your tax deferred, that has certain types of investments are better suited for that. And in the taxable, there are better suited investments in your taxable. Like in your taxable, you want high growth stocks, tech stocks. They don't issue dividends. They just grow, they appreciate, and you don't pay taxes on appreciation. And so in essence, you're able to defer those taxes until the time that you sell those investments. You don't want high dividend producing stocks or mutual funds. You don't want taxable interest like corporate bonds in a taxable account, because then you're going to pay these taxes every year, and that sucks. So this is one of the key things we do here at Practice CFO as investment advisors. Managing our doctor's assets is tax allocation across these different buckets, what you put in them. Most people, if you go to like Morgan Stanley, you go to Edward Jones, Raymond James, most typical investment advisors may do a little bit of that, like they'll put maybe tax-free California muni bonds in your taxable accounts. But beyond that, they're not doing a lot of tax strategy around positioning of your investments across these different buckets of tax-free, tax-deferred, and taxable. And yet that can get you 1% to 2% extra return over time. That alone pays our investment fees, in my opinion, as what I have found. And so this is a really important part of tax planning, and good investment advisors who are a little bit more savvy on the tax side may do this. And we pay good money to a tax software that allows us to configure in the software how or which investments are selected based on the type of account to optimize over all accounts the tax minimization on the growth of those investments. Okay. And then you have a defined benefit plan, and defined benefit plan is this additional thing. It's sometimes called a pension plan. Big corporations used to have them back in the 80s, where the company pays 100%. The employee doesn't contribute to this. The company pays 100%, and you're defining the benefit when you retire. How much are you going to pay out per the design of this benefit that you're offering to your employees? How much are you going to pay out when they retire, and you pay for the rest of their life? Now, in reality, when you sell your practice and you close down the benefit plan, everyone rolls it out into their own IRA. That's what happens every time. So you're not actually going to be paying your employees benefit from the time they retire to the end of their life. No, you're going to close it down, package it up in a lump sum, drop into their Roth IRA, and you'll do the same for your own defined benefit plan. Now, what I love about defined benefit plans is the vast majority of it goes to you. In a 401k, you might have only 75 to 80% going to you, the owner and spouse. But in a defined benefit plan, you're getting like 90% to you. but they're more expensive. They require an actuary. They're very delicate. You can't do it wrong. Otherwise, trust me, you're going to regret it with tax letters and penalties and excise taxes and all this stuff. This requires careful curating in the beginning and every year inside the ecosystem of all of your global cash flows. I just can't emphasize that enough. I would never do a defined benefit plan if you don't at least have a modest amount of business and personal financial planning and tax planning in place as the foundation to do that right. Okay, so if you do not have a 401k defined benefit plan or any sort of retirement plan in your practice, you want to keep your W-2 as low as possible because you're paying 15.3% FICA taxes on your W-2. Now, again, as an S-corporation owner, you take out income in two ways, your W-2 and your K-1, your K-1 being the net profit. If your W-2 to yourself goes up, that's an expense to the corporation, and therefore your profits go down, so your K-1 goes down. If you pay yourself a lower W-2, your profits go up, it means your K-1 goes up, and therefore your K-1 is higher. But the sum of your K-1 and your personal W-2 are always going to be the same. W-2 plus K-1 equals X. That X isn't going to change no matter how you shift your W-2 and K-1 because they're directly inversely related to each other.
You ever feel lost in your practice finances? And how about your personal finances? Ever wonder where your hard-earned money goes and why you're not seeing the financial progress you worked so hard for? If so, listen up. As a dental CPA and financial planner, I've created our company, Practice CFO, just for you. With almost 2 decades of experience, Practice CFO integrates great CPA services like accounting and tax with customized financial planning, both business and personal. Think of it this way. Our dental-focused CPA services give us the X-rays we need to clinically plan your global finances and be effective financial planners. It's a highly customized approach we call the CFO model. Historically, having a CFO or chief financial officer was an advantage of large corporations only. But today, Practice CFO gives that same advantage to private dental practice owners. As a client of Practice CFO, you'll be assigned one of our dedicated CFO advisors. You'll receive insightful financial reports each month, have regular financial review meetings, reduce taxes, grow your wealth, and feel more in charge of your numbers. Because we believe that in the competitive landscape of dental practice ownership today, you have to be an effective business owner, not just a capable clinician. Reach out to learn more at www.practicecfo.com.
And so if you don't have a retirement plan like a 401k or defined benefit plan, let's try to get your FICA taxes down as much as possible by paying you a low W-2. Now, I emphasize that teeter-totter analogy because what your W-2 is has very little effect on your taxable income when you don't have a 401k plan. It doesn't. If you lower your W-2, your K-1 goes up because the sum is the same. You're going to have the same amount of income that is taxable income to the IRS and the state income tax agency. What's different on those two ends of the teeter-totter is that only Social Security and Medicare, which is called FICA, which is 15.3% combined up to $176,000, that is only applied on your W-2. And so if I can take you down from $150,000 W-2 to $50,000 W-2, I'm going to save you about $7,000 to $8,000 in FICA taxes. And who doesn't want $7,000 or $8,000? And I think at $100,000, even if you have a really good big practice and you have a pretty big K-1, let's say your K-1 is $400,000 or $500,000. If your W-2 is $100,000, 6 figures, you're probably not going to be audited. You're probably just fine. It's when you're paying yourself like $25,000 W-2 and your K-1 is $400,000, the IRS is going to say, no, you should have paid yourself a higher W-2. And that's therefore more in FICA taxes. So there's a limit there. I usually don't go under 100,000 unless your practice is running a loss. Maybe you're a startup, or maybe you're an independent contractor and your total revenues, i.e. revenue, which is your production pay, is maybe 200,000. I may justify going down to $75,000 or so, but I almost never go down below 75, ever. Now, that's if you don't have a retirement plan, and that's us trying to save in FICA taxes. Again, income taxes doesn't matter. Let's go to the 401k without a profit share. The 401k without a profit share, or if you have a 401k, but you're not doing that other bucket of profit share, getting that additional 25, 30,000, you're just doing the elected deferral and the safe harbor bucket, then same thing. I wouldn't go above maybe 100,000, 125,000. It's when you want to fund that profit share bucket, that last layer in the 401k bundle, that last layer, and or that defined benefit plan. And I never do a defined benefit plan without the 401k. It's called a combo plan. These are like stairs. You first do the elected deferral safe harbor. I would never set up a 401k if I as the doctor am not doing at least the elected deferral and the safe harbor. That's the first step. The second step is the profit share, and the third step is the defined benefit plan. I always go in that order, depending on how much surplus money you have in your practice that you can allocate to these things. The more you can allocate, the more I tend to move into that next stair. And eventually, if you have a lot where you above the 401k profit share above that, if you have another $100,000, $200,000 to invest and you don't have many staff or you're a bit older than your staff, then I'm starting to look hard at a defined benefit plan because of the massive amounts of money these things can save. And sometimes a doctor will complain and say, Wes, I'm having to pay $5,000, $6,000 a year to fund my defined benefit plan. Oh, I'm like, yeah, that's true because there's an actuary in place and they're more regulatory intensive. And so they require more work and you're going to pay the TPA more money for that. That said, you're funding $250,000 in that thing. Do you know what that thing is saving you in taxes? $100,000 in taxes. And you're going to get this massive amount of money, $250,000, that's going to grow tax deferred for a long time and even end up being $1 million in your retirement account in 15 to 20 years. I don't mind you paying $6,000 every year to do the administrative compliance and actuarial work on this defined benefit plan. So you got to see the forest through the trees. That yes, there's a cost with these things, but the forest is massive tax savings and a massive propulsion toward financial independence. Okay, so tier 1, no retirement plan at all. Pay yourself as low W-2 as you can, never below 75 or 100,000. 401k without a profit share, same thing. All right, now you get into the profit share and the defined benefit plan layered on. Now you want to jack your payroll way up all the way for 2025. That's 350,000. Every year that's going up about 10,000, but you want to find out what it is for that year, that max W-2 limit, in order to optimize your profit share and defined benefit plan, which simply allows you to get more in and at a lower employee cost. And I'm not trying to be Scrooge. It's not that you don't want to provide the benefit to your staff. Trust me, if you have a defined benefit plan, they're getting way more contribution than they would at any other practice. Trust me, even at the minimum amount. Now, it still is a huge benefit to you, way more than the staff. This is about you. But they will get some defined benefit plan contribution and some safe harbor contribution. But when all is said and done, if you can get above 75 to 80% out of pocket is going to you, it is an absolute win. Now, when you layer on a defined benefit plan and you're funding $350,000 in this thing a year, you're getting somewhere closer like 92 to 95% is going to you. And it's all 100% tax deductible. So it's a beautiful thing, actually. It is a beautiful thing to do that. All right, so those are the primary drivers for me of what your W-2 target should be for the year. So the action plan is have your CPA recommend a payroll structure consistent with your tax plan and 401k or defined benefit plan. I have a resource called the 10 questions to ask your CPA each year that I will include in the show notes that can help drive that conversation. Ideally, your CPA can sort of do this more finance perspective analysis and not just be a historian. Or you can look at more of a CFO model. There's a few of us out there as what is just built in from the ground up. It's like some softwares now are built in from the ground up with AI, and they're probably going to do a lot better than the old legacy systems that are trying to sort of embed AI in there as well. For us, AI is embedded from the ground up, meaning that business planning, personal financial planning, tax planning, it's all embedded from the ground up in our model since we are a finance wealth management firm first and a CPA firm second, with the CPA firm driving the data engine and X-rays to be great business and personal financial planners. Thanks everybody for joining another episode of the Dental Boardroom Podcast. Until next time.